Welcome back to Boni's Life, the only place where we cut through the noise, ignore the mainstream panic, and look at the cold, hard data. I am Boni, and today we are diving deep into the crypto markets. Whether you are a short-term scalper looking for the next 5-minute breakout, a mid-term swing trader riding the weekly waves, or a long-term diamond-handed investor, this episode is your ultimate survival guide. We are going to analyze the past market performance using both technical and fundamental analysis, look at the volume, total market capitalization, the fear and greed index, open interest, and liquidations. We will outline the global events shaking the markets right now. And finally, I will give you the exact technical setups, triggers, and strategies to successfully trade this market. Grab your coffee or your energy drink of choice and let us get into it. Let us start with the big picture. We need to understand the foundational metrics before we can even begin to talk about price action. The fundamental data is the bedrock that drives the entire ecosystem, and ignoring it is a recipe for disaster. As of April 9th, 2026, the global cryptocurrency market capitalization stands at $2.483 trillion. We have seen a slight dip of 0.5% in the last 24 hours, but do not let that fool you into thinking the market is asleep. The 24-hour trading volume is a massive $81.769 billion. This tells us that despite the fear, money is moving. Institutions are positioning themselves and whales are quietly accumulating. Bitcoin dominance is sitting at 58.85%, up slightly, while Ethereum holds about 10.5% of the market. This high Bitcoin dominance is a classic sign of a risk-off environment within the crypto space itself. When people are scared, they flee to the perceived safety of Bitcoin, draining liquidity from the altcoin market. We are looking at a market that is highly liquid but incredibly tense, waiting for a catalyst to pick a definitive direction. Speaking of tension, let us talk about the fear and greed index. This is perhaps one of the most crucial psychological indicators we have at our disposal. Right now, it is sitting at a chilling 13. That is extreme fear, ladies and gentlemen. In fact, the market has been stuck in this extreme fear zone for over 60 consecutive days. This is the longest stretch of extreme fear we have seen since the dark days of late 2022. It is a level of sustained panic that shakes out the weak hands and tests the conviction of even the most seasoned investors. When the masses are terrified, the smart money is usually paying very close attention. As Warren Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. But in crypto, we do not just buy blindly based on a single metric. We look at the derivatives data to see where the real pain is and where the leverage is concentrated. Let us pull back the curtain and look at open interest and liquidations using data from CoinGlass. This is where we see the true mechanics of the market, the hidden gears turning behind the spot price. Total open interest across the crypto market is currently $112.98 billion, down about 2.88%. In the last 24 hours alone, we have seen $217.59 million in liquidations, with the vast majority being long positions getting wiped out by sudden downside weeks. Bitcoin specifically has $51.52 billion in open interest. What is truly fascinating here is the long/short ratio. On Binance, the top trader accounts are leaning slightly long at a ratio of 1.13. However, there is a massive concentration of leveraged short positions, roughly $6 billion worth, sitting right between the $72,200 and $73,500 levels. These are traders betting heavily that the resistance will hold. If spot demand pushes the price into that zone, we are looking at a potential liquidation cascade. When those shorts are forced to cover, they have to buy Bitcoin at market price, creating a massive short squeeze that could send Bitcoin rocketing toward $80,000 in a matter of hours. Now, we cannot talk about price action without talking about the macro environment and global events. Crypto does not exist in a vacuum. It is highly sensitive to global liquidity and geopolitical stability. We are currently living through what analysts are calling a double shock. First, we have the lingering effects of the tariff wars. A year ago, the so-called Liberation Day tariffs crashed Bitcoin, sending shockwaves through global trade. While the Supreme Court struck down the original tariffs in February 2026, the administration quickly pivoted to a 10% global blanket tariff under Section 122 of the Trade Act of 1974. This has kept inflation sticky, strengthened the dollar, and significantly reduced the risk appetite across all asset classes. The US dollar index is currently hovering around 98.68, A strong dollar is traditionally a massive headwind for Bitcoin, as it makes dollar-denominated assets more expensive for global investors. The second shock is geopolitical, and it is arguably the most volatile variable in the equation right now. On April 8th, a 2-week conditional ceasefire was announced between the US and Iran. This news caused Brent crude oil to plunge from $115 to $96 a barrel, sparking a massive relief rally across risk assets. Bitcoin surged past $72,000 on this news, as the market priced in a de-escalation of conflict and a potential easing of energy-driven inflation. However, this ceasefire is incredibly fragile. Tehran is already claiming that clauses have been breached within the first 48 hours, and the Strait of Hormuz remains effectively closed to major shipping. If this ceasefire collapses entirely, oil prices will spike violently again, inflation fears will return with a vengeance, and risk assets, including crypto, could take a severe hit as investors flee to safe havens like gold. We also have massive economic data dropping this week that could dictate the trend for the rest of the month. Tomorrow, April 10th, we get the US Consumer Price Index, or CPI, for March. This is the first inflation print to fully capture the recent tariff period, making it the most important macro event of April 2026. If inflation comes in hotter than expected, the Federal Reserve will be forced to keep interest rates higher for longer, which could suppress crypto prices and strengthen the dollar further. On the regulatory front, the Clarity Act is heading for a Senate Banking Committee markup in late April. This act aims to create federal rules for digital assets and stablecoins, delineating regulatory jurisdictions and establishing workable registration pathways. If passed, it could provide the regulatory certainty that institutional investors have been waiting for, acting as a massive bullish catalyst that could define the second half of the year. Let us transition into the technical analysis, starting with the long-term view. For the diamond hands out there, the investors who are looking at the multi-year horizon, Bitcoin is currently trading around $70,500. It is down about 47% from its late 2025 all-time high of $126,000 and down about 25% year-to-date in 2026. However, context is everything. The spot Bitcoin ETFs just saw a massive $471 million net inflow on April 6th. Institutions are buying the dip, they are accumulating while retail is paralyzed by fear. On the weekly chart, the 200-week moving average is acting as a massive foundational support. Most serious analysts view the $62,000 to $68,000 range as the definitive bottom for 2026. If you are a long-term investor, this is the accumulation zone. The strategy here is dollar cost averaging. You are not trying to catch the exact bottom. You are building a position before the macroeconomic clouds clear, and the Clarity Act potentially opens the floodgates for institutional capital. You are buying the fear to sell the greed later. For the midterm swing traders, the daily chart is where the action is. You are looking to capture moves that last from a few days to a few weeks. Bitcoin has been trapped in a brutal consolidation range between $62,000 and $75,000 for 2 months. We saw a bearish death cross in November when the 50-day EMA crossed below the 200-day EMA, signaling a shift in momentum. However, the recent ceasefire rally allowed Bitcoin to reclaim the 50-day EMA, which is currently sitting around $68,700. The 14-week RSI is holding below 40, which is technically bearish on the higher timeframes, but the daily RSI is hovering around a neutral 50. We are also seeing a bearish flag pattern forming on the daily chart after the pullback from the weekly high of $72,550. This indicates that the market is coiling, building energy for its next major directional move. So, what is the midterm strategy? You are playing the range until a definitive breakout occurs. Your key support is $68,700. If Bitcoin loses that level on a daily close, the ceasefire rally was just a lower high, and we are likely heading back to test the $62,000 floor. If you are shorting, a break below $68,700 is your trigger to enter a position. On the flip side, the massive resistance is at $75,000. This level has kept every single rally since February, acting as an iron ceiling. If we get a daily close above $75,000, that is your bullish trigger. It invalidates the bearish structure and opens the door for a test of the November 2025 lows around $80,000, and eventually the 200-day EMA at $84,000. Midterm traders should set alerts at 68,000, 775,000 and wait for the market to show its hand. Patience is your greatest asset here. Now, for the short-term traders, the scalpers, and the day traders, you thrive on volatility, and right now, the market is giving you plenty of it. The key for you is the derivatives data and the immediate news cycle. Remember those $6 billion in leveraged shorts sitting between $72,200 and $73,500? That is your target zone. If the CPI data tomorrow comes in cooler than expected, or if the ceasefire holds and oil continues to drop, we will see a sudden spike in spot demand. Your short-term strategy is to watch the $71,500 level on the 1-hour and 4-hour charts. If we break above $71,500 with strong volume, you go long. Your first take-profit target is $72,200. If the price pushes into that $72,200 to $73,500 zone, you hold on tight because you are about to ride a liquidation cascade. The forced buying from liquidated shorts will act as rocket fuel, potentially pushing the price violently towards $75,000. You trail your stop loss tightly behind the price action to lock in profits. Conversely, if the CPI data is hot, or if the ceasefire officially collapses, you watch the $70,000 psychological support. A high volume break below $70,000 is your trigger to go short, targeting the 50-day EMA at $68,700. You must be nimble and ready to flip your bias at a moment's notice. And let us not forget about the rest of the market. Ethereum is currently trading around $2,162. It has taken an absolute beating, down over 30% in the first quarter of 2026. The ETH to BTC ratio continues to bleed, showing that Bitcoin is absorbing most of the capital in this fearful environment. For traders, Ethereum is currently a high beta play on Bitcoin. If Bitcoin breaks out, Ethereum will likely follow with higher percentage gains due to its lower liquidity. But if Bitcoin dumps, Ethereum will bleed much harder. The key resistance for ETH is $2,250. Until it reclaims that level, the trend remains heavily bearish, and any longs should be treated as counter-trend scalps. Solana is another one to watch closely. It is currently sitting at $81.46. It showed incredible relative strength during the ceasefire rally, bouncing back above $80 while other altcoins struggled. Solana has become the go-to chain for retail speculation, decentralized finance activity, and meme coin trading. If the broader market sentiment shifts from extreme fear back to neutral, Solana is primed for a massive explosive move. Short-term traders should watch the $85 resistance level. A break above that could see a quick high momentum move to $95. However, if the macro environment deteriorates, Solana's high beta means it will fall just as fast. Let us dive deeper into the concept of market cycles and how they apply to our current situation. Historically, Bitcoin operates in 4-year cycles, largely driven by the halving events. However, the 2026 cycle has been uniquely distorted by the unprecedented macroeconomic factors we discussed earlier. The introduction of the spot ETFs fundamentally changed the market structure, bringing in a massive wave of institutional capital that operates differently than retail investors. Institutions do not panic sell on a 10% dip. They rebalance their portfolios. This is why we are seeing such strong support in the $62,000 to $68,000 range. The ETF inflows act as a shock absorber against the geopolitical and tariff-driven volatility. Understanding this structural shift is crucial for anyone looking to trade this market successfully. You are no longer just trading against other retail participants. You are trading alongside Wall Street algorithms and sovereign wealth funds. Furthermore, we must consider the impact of the broader technology sector on crypto valuations. The correlation between Bitcoin and the Nasdaq 100 has fluctuated, but it remains a significant factor. As artificial intelligence continues to dominate the traditional tech narrative, we are seeing a spillover effect into crypto projects that integrate AI technologies. While Bitcoin remains the undisputed king of digital scarcity, the altcoin market is increasingly fragmenting into specialized sectors. Traders need to be aware of these sector rotations. When liquidity flows back into the market, it will not lift all boats equally. It will flow into the narratives that have the strongest fundamental backing and the most active developer communities. This is why keeping an eye on projects building real-world utility, particularly in the decentralized physical infrastructure networks or DePIN and AI sectors, is essential for mid to long-term outperformance. Risk management cannot be overstated in a market characterized by extreme fear and high volatility. The single biggest mistake traders make is over-leveraging their positions. When you see a potential short squeeze set up like the one at $72,200, the temptation is to go all in with 50 times leverage. This is a surefire way to blow up your account. The market makers can see the same data you do, and they will often engineer stop hunts, sudden, sharp price movements designed to liquidate over-leveraged positions before the real move occurs. Your position sizing should be small enough that a total loss on a single trade does not materially impact your overall portfolio. Use strict stop losses and never move them further away as the trade goes against you. Accept the small loss, preserve your capital, and wait for the next high probability setup. Let us also touch upon the psychological aspect of trading. The fear and greed index at 13 is not just a number. It represents real human emotion. It represents panic, despair, and capitulation. As a trader, you must train yourself to detach from this collective emotion. When the timeline is flooded with bearish predictions and calls for a return to $40,000, that is precisely when you need to be looking for long setups. Conversely, when everyone is euphoric and predicting $200,000 by next week, that is when you start taking profits. The market is a mechanism for transferring wealth from the impatient to the patient and from the emotional to the disciplined. Cultivate a mindset of objective analysis. Trust the data, trust your charts, and ignore the noise. Let us look ahead to the rest of the year. If the Clarity Act passes and provides the regulatory framework the industry desperately needs, we could see a massive influx of capital from traditional financial institutions that have been sitting on the sidelines due to compliance concerns. This, combined with a potential stabilization of the geopolitical situation and an eventual easing of the tariff policies, could create the perfect storm for a massive bull run in the second half of 2026. The current consolidation phase, as painful as it may be, is simply the market building a foundation for the next leg up. We are in the accumulation phase. Act accordingly. To summarize, we are at a critical inflection point in the 2026 crypto market. The macroeconomic data is heavy, the geopolitical situation is on a knife's edge, and the technical charts are coiled like a spring waiting to release energy. The $62,000 to $68,000 zone is the macro bottom for long-term accumulators. The $68,700 to $75,000 range is the battlefield for mid-term swing traders. And the $72,200 short liquidation zone is the golden ticket for short-term scalpers. Trading is not about predicting the future with absolute certainty. It is about managing risk, understanding the probabilities, and reacting to the data as it unfolds. Do not let the mainstream media panic shake you out of your positions, and do not let the extreme fear index paralyze you. Have your plan, set your triggers, and execute without emotion. That is how you survive and thrive in this market. If you found this analysis valuable, make sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. The YouTube algorithm loves engagement. So drop a comment below and let me know. Do you think the $62,000 bottom is in, or are we heading lower? I read every single comment. Until next time, stay sharp, stay disciplined, and keep trading the data, not the noise. This is Boni, signing off.